Hello students, welcome to another video. We're going to be continuing where we left off. When we're looking at chapter 2's content, we need to understand what the focus is. As you've seen in the previous video, we're looking at the objectives and purposes of accounting and the recording. So remember, accounting is a way to record information so that that can be used to make decisions. In this next section, we're going to be continuing on page 20 in the actual textbook. You'll see the first thing that we need to look at is the differences between internal versus external reporting. So if we discuss that concept in an example, if we're looking at the two different types of reporting, how does the one differ from the other? Well, when we're looking internally, so internally would be management accounting. That's what we talk about when we look at internal accounting or record keeping or reporting. When we're looking at the external reporting, then we're looking at the financial accounting. So you get two types of accounting in terms of detail, okay, and layout and format. So when looking at internal reporting, managers inside the business need more detail. So they would want to know which products are selling the best. They would want to know what the markup or margin is on each product. They would want to know how many employees they have in the company and what does each employee earn. They would want to know how much all the costs are for every single procedure or operational process that needs to be implemented in order to derive a desired result, okay, or output. So just remember that with management accounts, we're looking very detailed. With financial accounting, it's much more summarized because it's external reporting. Remember, external means outside shareholders or outside users. Those shareholders don't necessarily want to know all the detail. In other words, a shareholder wouldn't really want to know exactly which product is selling. A shareholder would just want to know how much profit did the business make, what was the total sales. Right, if we're looking at detailed management accounts, then obviously knowing which product is selling the best is obviously ideal and the best source of information for making decisions to help grow or improve the business. So just remember, internal accounting is management accounting, external accounting is financial accounting. Please have a look at the examples here which they talk about. Something else to maybe highlight is taxes. Okay, SARS. SARS would be seen as an external third party. Okay, is SARS part of management of a company? No. SARS is a body that's required to collect taxes from companies, individuals, etc. Okay, so what would SARS want? Would SARS want detailed records or would SARS want more of a summary? Well, SARS would want a summary because they would want to know how much revenue you've generated in terms of sales and ultimately how much profit has the company made. Okay, notice if it's management accounting, we would want more detail. We would want to break up the sales maybe in terms of location, maybe even type of item, etc., etc. Okay, so you can see that management accounts are a lot more detailed, financial accounts are more summarized. In the textbook, they describe that in a bit more detail by highlighting the different types of accounts that you can get. The first group or set of accounts are management accounts. And if you look at the actual detail here, they talk about the day-to-day bookkeeping. Okay, that's very, very detailed. Debtors, creditors, tax, etc. Right, all of that needs to be kept in detail in the business's accounting records. Right, so when we look at management accounts, you need to know the detail. In other words, you need to know exactly which debtor owes you how much and who do you owe. Okay, we've spoken about debtors and creditors previously, and I even touched on it in the live session as well. A debtor would be someone that we have sold to on credit. Okay, so customers that have bought on credit are called our debtors. Okay, we've sold to them on credit. Creditors are our suppliers, people that we've bought from and that we owe. All right, so debtors is an asset and creditors is a liability. Okay, debtors owe us and we owe our creditors. So when you're looking at management accounts, if we're looking at a summary, would shareholders want to know who all the debtors are? No, they wouldn't, right? Because that's summarized. External reporting, you would have to report on the total debtors. If it was management accounting, so internal accounting, you would have to report on Mr. A, B, C, D, etc., etc. Right? Every single individual needs to be tracked and monitored because it's internal accounting, it's management accounting. All right, so just remember big picture thinking. Okay, management accounts shows detail. It shows the depth in terms of budgets, forecasts, expenses, etc. These are all some questions that you can maybe consider in terms of management accounts and what that entails. Okay, so just to keep it simple, management accounting is detailed and it's internal. Financial accounting is less detailed, more summarized, and let's look at external reporting. All right, let's have a look at the next topic, external reporting. We've already touched on the topic of financial accounting being the focus. Right, when we're looking at financial accounts, okay, so we're looking at external reporting. So in other words, we're going to be generating financial statements for external users to make use of. Earlier on in one of our previous videos, I showed you process and NASPers as two example public companies. Because they're public companies, all public companies in South Africa are listed on the JSE. Because they're JSE listed companies, there are very, very strict requirements that all those companies need to adhere to and satisfy in terms of the requirements. Right, so what do we call that? We call that IFRS, International Financial Reporting Standards. All public companies in South Africa listed on the JSE need to follow the same set of rules because all of them are going to be reporting to external users. External users could be the auditor, it could be investors, shareholders, maybe even government in terms of SARS. Just to highlight what IFRS is, International Financial Reporting Standards is the rules that we would have to follow and adhere to when presenting that information. Right, so when you learn about assets, liabilities, income, expenses, capital, drawings, those are all the different accounts that have very specific rules that are covered in IFRS. So please take note that IFRS is just a language. It's kind of like the dictionary. If I use that analogy, IFRS is the dictionary for accounting. Like in English or other languages, you have a dictionary. Okay, in accounting, the dictionary is IFRS. So IFRS outlines the rules, the definitions, all the detail that we require when presenting information to external users. And as you can see here, IFRS is used in many countries around the world. Right? It's the most widely used set of accounting records. There are others as well. So the countries that you see here are countries that also include South Africa. And if you look at America, USA, right? The USA uses GAAP, USA GAAP, right? Generally accepted accounting principles and practices. Okay, so the US have their own system, right? IFRS is obviously international. Okay, it's kind of like English. English is a internationally spoken language. Okay, many different countries around the world speak English. USA have their own set of accounting rules. Okay, so they have a slightly different system, but it's very, very similar to IFRS. Okay, IFRS is the most widely used and it's international, and that's what we use in South Africa. Okay, so in South Africa, we use an international set of rules governed by the International Accounting Standards Board. Okay, so the IASB, the board, determines the framework and the interpretations and basically manages the rules that are outlined in the IFRS in terms of standards. Okay, so just remember, when looking at accounting rules and records, you're learning something that's international. Many, many countries around the world use this system, this accounting language, to represent information to their users externally and internally as well. Okay, when we're specifically focusing on external reporting, then IFRS is very, very, very important because it guides you in terms of how the information is presented. When you looked at NASPers and processes, accounting records, those annual reports that I showed you in a previous video, those reports have to follow specific formats. They call that disclosure. Disclosure means how do we present information? What's the layout? What's the format? Okay, so very fancy word, looking at layout format for accounting records. Let's continue. There's a bit more background here regarding IFRS. You can see IFRS comprises of the following. Okay, lots of standards, lots of rules, obviously governed by the body for accountants to make sure that they're following the correct set of rules. In South Africa, we have SAICA, the South African Institute of Chartered Accountants. And that body is obviously used to govern accountants that are practicing at the highest level in this country. Just remember that financial statements need to reflect everything truly, okay? In other words, with the highest integrity, it needs to be fair, it needs to be accurate, it needs to be reliable. Right, so financial statements need to follow specific rules. If we follow IFRS and we adhere to all the rules and regulations, then users have some peace of mind because they would then believe and trust that information because it's based on IFRS. Not to say we can't have instances where we do have accounting irregularities, and that's something that we spoke about in terms of Steinhoff and how Steinhoff was guilty of fraud and corruption and accounting irregularities. So just remember, when dealing with reports, okay, all reports have a specific format. Maybe one day when you're required to submit or produce a report, there'll be a specific layout or format that you need to follow. For those of you that are studying part-time and working full-time, I'm sure you've probably been involved with reports or creating reports or helping with the reports or even reading reports, depending on what role you have. Okay, so just remember that in accounting, the same thing applies. When we have financial reports, okay, we call those financial statements. Okay, those financial statements need to follow certain rules and regulations. IFRS is what we're going to have to follow. On the next set of notes here, you have something very specific in terms of IFRS. IFRS also outlines the qualitative characteristics that we would have to comply with for financial statements to be of higher quality. Okay, the word quality is actually in the word qualitative. Okay, qualitative characteristics. Okay, we're looking at quality. We're looking at characteristics that would help improve or increase the quality of the information that's being presented. Remember, we said accounting is all about information that people can use to make decisions. So if I'm looking at accounting information, we need to make sure that it's relevant. Okay, these are the fundamental qualitative characteristics. Relevance is important. It needs to make sense. It needs to be relevant. It needs to be able. We need to be able to apply it correctly. It needs to influence our decision making. Right. So if we had information that's not useful, that's not relevant, then how are we going to use that information? It wouldn't be useful information. It would be useless information. So just remember that qualitative characteristics add to the quality, okay, for a lack of a better word, of the information that we're going to utilize when making decisions. Something else that's also described under this concept relevance is the word material, okay, or materiality. If something is material, we're looking at something that's going to affect or influence economic decisions. A simple example would be, let's think about a large company like Process or Naspers, okay, or even something smaller, maybe Media24, okay, a smaller subsidiary of Naspers. If you're looking at Media24 as part of the bigger business, what happens if they couldn't account for some stationery? Let's assume there's 500 Rand worth of stationery that they couldn't account for. Right? Maybe it was damaged, maybe it was lost, maybe it was stolen, whatever the case might be. Right? Would we stress about 500 Rand worth of stationery if I'm looking at the Naspers financial records? No, we wouldn't. Okay, but if we were looking at the department, obviously you might want to do investigations. You might want to find out what happened to that stationery. Okay, but the point is, you've got financial accounting and you've got management accounting. If it was management accounting, managers would want to investigate what happened to the stationery if you've lost some of it in that department, obviously. But when looking at Naspers as a whole, okay, bigger picture, Naspers makes billions and billions and billions of dollars in terms of revenue and profitability for some businesses. 500 Rand worth of stationery for a business that size in terms of reporting wouldn't be material, right? It would be material if we were looking at, let's say, a sole proprietor. Okay, let's say you're running a small business, okay, you as the individual had 500 Rand of stationery that went missing. Right, that would definitely be material, and you would definitely want to find out what's happening in that scenario. Okay, there are some other qualitative characteristics as well that we need to have a look at. Faithful representation. Faithful representation is looking at the accuracy, the reliability of that information. How accurate, how truthful and honest is that information. Obviously, we want accounting records that are honest, that are true, that are correct. And that's what we're looking at there. Fundamental characteristics, information, okay, financial statements need to be faithfully represented. Those financial statements should also be comparable. So I can compare maybe 1 year to another, or maybe one type of business to another, or maybe I can compare different locations, etc. Right? Comparability helps enhance the characteristics, the qualitative characteristics of the financial statements. And there are a few more. In the textbook, they describe understandability. Okay, so that information needs to be laid out in a specific way that can make it easy for us to understand, read, and interpret. Okay, so it shouldn't be difficult to understand. There should be a greater level of understandability. And if you've covered more accounting, you'll have better understandability. And that will obviously help you to interpret that information. Something else in terms of a qualitative characteristic that will help improve those financial statements is timeliness. If I'm looking at accounting records, do you want it to be outdated? No, you don't. You want those records to be recent. Okay, so if I have a set of accounting records for NASPers, I would want to know how they've performed over the last financial year, not 5, 10, 20 years ago. Okay, that's not relevant, that's not timely, it's not something that's recent. Okay, so timely information is important. It's another characteristic that helps to improve the overall quality of the financial statements. And then the last one here is verifiability. Verifiability means, are we able to check? Are we able to confirm? Can we verify if something has been done correctly? So the more supporting information you provide, where you can actually verify and you can see that the information is reliable and correct and faithfully represented, that obviously adds more to the overall quality of that information that's provided. Okay, so just to keep it simple, just to wrap up this particular video because of the time constraint regarding uploads onto CoCampus, just think of qualitative characteristics as those characteristics that help improve the information, the usefulness of the information. The more useful the information, the better. And the usefulness of the information is determined by these different characteristics.